Hi everyone, this is a lesson for term 2 in the production function. You have previously or hopefully already done most of the production function. This is the very last part and it is production costs. The main aim of a business is to make profit and to make money, and they do this by specifically determining what or at what price to sell their products. It is important that the cost accountant provides management with accurate cost calculations so that the business can sell at a competitive selling price. The cost accountant will work closely together with the purchasing and production departments to try and minimize the costs. Here is a few examples of the production cost of Nike shoes. At the top, Nike Air Max 2016, we can see that the production costs were $33, but they still sold at $190. That is more than 100% markup and shows, quite frankly, that if you accurately determine your production cost, you can make a lot of profit. In production costs, there are certain questions that they can ask you. For example, number 1, calculate the total production cost. And that is, what will it cost us? Let's say we're making shoes. What will it cost us to make 50,000 shoes in total? Number 2, calculate the price per unit. So basically, what will it cost us to make one shoe? Number 3, calculate the selling price. Now that we know what it costs us to make one shoe, that's the cost price, what are we going to sell it at? How much percentage profit markup are we going to add? And that they will normally give you. Number 4, calculate the profit. That is the most easiest one. And number 5, calculate the break-even point. We are going to discuss each of these in detail. Number 1, calculate the total production cost, abbreviated to TPC. And the formula to do this is primary cost plus overhead cost. What do we include in primary cost? We include things like direct labor and direct material. Direct labor is labor for employees that are directly involved in manufacturing the product. So like paying their salaries. Let's say we're manufacturing shoes. Direct labor will be the factory workers assembling the shoe. Not the accountants, not the secretaries, because they are not directly involved in manufacturing the shoe. Direct labor is the material needed to make the shoe, like the inners, like the laces, like the soles. Things like the boxes you buy the shoe in, the packaging, that is not direct material. Direct material is the product itself. Then, to calculate the total production cost, we also need to consider overheads. And that's your extra things that you have to consider above and beyond the physical product, making the physical product. In overheads, we include fixed overheads like rent, depreciation, and insurance. Fixed, the word says it. It will not change. Fixed, these costs will always stay the same. It doesn't matter how many products you manufacture, they will always stay the same. Variable cost, variable overheads, are things like water and electricity, packaging, marketing, and telephone accounts. Water and electricity will differ. It will depend on how long the factory is running, how long the factory is open. Packaging the price will be determined by the amount of products you make. So variable overhead cost change depending on the amount of products manufactured. If you add these two together, that would give you your total production cost. Let's have a closer look at overheads. Variable overheads varies in relation to units produced, while fixed overheads remains the same irrespective of the output. And examples are rent, insurance, and salaries. Here's a few more examples in detail for you. Look at this one. Variable, remember it changes, is a new example. Advertising and publicity. If you had to look at it practically, this is what it would look like. Variables, they change depending on the output. So here you can see the higher the sales amount, the higher the variable cost. On this side, here you see it's a straight line. So fixed, it stays the same. That is why it's a straight line. And if you combine the two, this would be your total overhead costs. Question number 2, calculate the price per unit. To calculate the price per unit, you take the total production cost, either calculated by you or they will give it to you. You take the total production cost and you divide it by the units manufactured. So let's say they tell you we manufacture 20,000 units, then you're going to substitute 20,000 in there. Question 3, calculate the selling price or calculate the cost price. Now let's look at the first one, selling price. The main objective of a selling price is to make it higher than your cost price so that you can actually make a profit. So it must always be higher than your cost price. And if you look at these two formulas, they will not be given to you on a formula sheet. You will have to know them off by heart. And these values here, you will have to substitute them. So if they ask you to calculate the selling price, you're going to use this one. If they ask you to calculate the cost price, you're going to use this one. In the previous section of the production function, we looked at price determination. So how do we determine what the price would be? And the normal or the most used method is cost plus profit. So you take your total cost plus your percentage of profit. Question number 4, calculate the profit. So how much profit did we make? How will I know this? You take your total income minus all your expenses. Or if they ask you profit per unit, you would take your selling price minus your cost price. And the difference then is the amount of profit you make. Question number 5, calculate the break-even point. First of all, what is a break-even point? It is the point where you have started selling goods, your products, and at some point you do not make a profit, but you do not make a loss. So it's that in-between part. This means income generated from sales is equal to the total production cost. And as soon as the business increases the volume of production, then only a profit will be generated. So it normally does take a bit of time to make a profit. This is what it looks like. On this side is the cost. On this side, we see the units sold. Your blue line is your total costs to manufacture a product. The red line shows the sales. And this here is the specific point at which you will break even. So if you sell 5,000 units, that means you have broken even. You didn't make a profit, you didn't make a loss. If, for example, you sell 7,500 units, if we look upwards, then we will see that we've made a profit. So basically we have to sell more than 5,000 units to make a profit. This whole section over here is when we'll make a profit. On the opposite side, let's say we sell 2,500 units, then we are going to make a loss. So this whole part here is where we make a loss. If we want to calculate the specific point where we break even, we use the fixed cost that never change over selling price minus variable cost per unit. And we will still do an example of this. Okay. Let's look at this. We have said that the break-even point is fixed cost over selling price minus unit variable, sorry for my handwriting, cost. Now they give you this. You need to substitute. Okay, let's see. Rent will always be the same. Therefore, it's fixed. Salaries will always be the same because salary is a fixed income. So 10,000 plus 20,000 gives us 30,000. Okay, let's see. The selling price, they give us selling price for 1 unit is 10 Rand. There you go. You substitute it in there. The variable cost per unit is 5 Rand, and there you substitute it in there. And if you input this on your calculator, it will give you an answer of 6,000 units. Remember, units, not rands. That means you need to sell 6,000 units in this specific scenario to break even.